welcome to GST with Saradha. So today in this video we are going to talk about the latest 52nd GST Council meeting recommendations. Yes, so the press release basically it contains about 8 pages and we have, it is broadly split into 3 categories. Category number 1 is about the rate of tax related changes on goods and services, which we are not going to deal with in this particular video because it's very industry specific or specific to the particular goods or services. And the second category is what we are going to look at, that is on the measures for facilitation of trade, and the third category is measures pertaining to law and procedures. So these are the 2 categories which we are going to look at it today. And we have about 6 points in this measures for facilitation of trade, and we have about 2 points in the measures pertaining to law and procedures, right? So which means put together we are going to talk about 8 broad aspects which has been discussed in this GST Council meeting recommendations. So let's quickly move on to each and every topic. It's going to be really interesting. So point number 1 is on the amnesty scheme. Amnesty scheme is not something new in the GST law. We all know that we have already had it in instances like late fees waiver or the kind of GSTR 1 and 3B related aspects, or GSTR 9, GSTR 4. We have got n number of amnesty schemes in the GST law, and this time the amnesty scheme is relating to the appeal applications which can be filed against the first level orders, right? So we all know that several orders are being issued under GST law, and section 107 gives the related provisions relating to first level of appellate procedures. Now what happens here is, as per section 107, the time period which is available for appeal application is 3 months from the date of order, and you also have 1 month for condonation of delay. Now having said that, section 107 is a very wide provision which covers appeal application relating to any order which has been passed under the GST Act. Now what about this amnesty scheme? The amnesty scheme says that any such order which has been issued under section 73 or 74. So carefully you need to understand that this is not applicable for all the orders which are issued under GST law. It's only for the orders issued under section 73 and 74. And to be precise, you cannot cover situations like the goods retention cases related orders like under section 129, or you cannot cover the RFD 06 refund related orders. Those things are not being covered in this amnesty scheme. So it's only for the orders which are relating to section 73 and 74. And what exactly is the relief that they have given is that any order which has been passed until 31st March 2023 relating to those orders, even if the time has lapsed, or even if you have already submitted the appeal application and that got rejected purely on the grounds of time limitation. So all such cases you can file the appeal application now within 31st January 2024. So the important point here is, even if you have missed it on time limitation, or you have already lost the case on time limitation in the first appellate authority also, in all those cases you can basically go for a fresh appeal application, and that needs to be filed within 31st January 2024, right? And one important point again here, what they are trying to say is that normally for an appeal application at the first level, the pre-deposit requirement is 10% of the disputed tax. So naturally for undisputed tax you may have to pay it 100% because you are not disputing that at all. Now for the disputed tax you have to pay at least 10% as a pre-deposit, but under this particular amnesty scheme it's not only the 10%, you need to pay an additional 2.5% also, which means 12.5% is the pre-deposit that you need to make. Point number 1. Point number 2, now normally for this 10% pre-deposit you can either pay it by way of cash or credit, but having said that, when it comes to this amnesty scheme relief, you can still pay the 10% under using cash or credit, but for a 2.5% you need to mandatorily pay it through cash and not under credit. So this is again another important aspect when it comes to this particular relief mechanism. So to sum it up all, you can go for an appeal application for any of the orders which has been issued until 31st March 2023 relating to any financial year which has been issued under section 73 or 74, even if it has been already rejected on the grounds of time limitation, and that needs to be filed within 31st January 2024 with a pre-deposit of 12.5%, out of which 2.5% at least should be paid by way of cash. Now, having said that, though absolutely this is a welcoming relief from a taxpayer's perspective, it has its own limitations. As I said, it's only for 73, 74. So what about the other provisions that's not being covered here? And it also says something like, who could not file. So does it mean, it's only about the inability to file, or is it applicable for anyone who is not able, who has even failed to file? So does it also get covered? So we have a lot of, limitations as we read this particular relief which has been given in the press release. So we need to wait for the actual notifications to come. I'll probably try to make a separate video analyzing what are all the limitations which is there in this, and let's also see how it's going to actually turn out in the notification. Now moving on, the next point. The next point is going to be on the personal guarantee and corporate guarantee. So when it comes to the personal guarantee, I think already I have made a very detailed elaborate video on the director's remuneration for any services which is provided by the director to the company, how the the taxability under GST law has to be evaluated. So I'll probably share the link of that particular detailed YouTube video in the description box as well. Now coming back, what exactly is the clarification that they are trying to provide here is, there is something called as personal guarantee. Now what is this personal guarantee? The director is not giving this as a service to the company, but for the company, the director is giving a personal guarantee to the banker. So basically, whenever a corporate goes for a loan, sometimes the banker will insist that the director should give a personal guarantee that in the case of failure of the company to meet this loan liability, the director is personally liable to meet it. So that's exactly what is personal guarantee. Now this is typically how the revenue department looks at this is that this is a service which the director is providing to the company by way of giving the personal guarantee to the banker. So this has been a dispute under GST law, and now what is the clarification that they are trying to give? They are probably trying to give a partial relief, at least to the extent where there is no consideration directly or indirectly, right? So when there is no consideration directly or indirectly which is paid by the company to the director, there is no value at all which is attached to it, no consideration, and hence no tax liability at all under GST law. So this settles the dispute predominantly, but having said that, they are also trying to say that indirectly or directly or indirectly consideration should not be there. So which means the department officers still have the scope to say what is an indirect consideration as well. Now let's not get into that part, but having said that, at least as long as a taxpayer is able to prove that there is no consideration involved, wherein the company is not paying any consideration to the director for the purpose of this personal guarantee, there is no GST at all. Point number one. Point number two, corporate guarantee. Now what is this corporate guarantee? Just like how there is a personal guarantee given by the director, this is a corporate guarantee, which means it is a guarantee which is given by one corporate to the banker for the purpose of loan taken by another corporate. So ideally it will usually happen in the case of related party, wherein the companies are related to each other, the associate enterprise. Most probably, in fact, in the case of holding company and subsidiary as well. So the subsidiary is basically going for a loan, and the banker is specifically asking for a corporate guarantee to be given by the holding company, right? So this is, if at all the subsidiary company, after taking the loan, if there is a default, then the holding company is responsible for it. So it's just like how it works typically in any kind of bank loan or financial institution loans. Now what happens here is that the GST law considers that this act of this holding company extending the corporate guarantee to the banker is a service which the holding company is giving to the subsidiary company. That's exactly how it's being construed. Now the important question here is, how does the valuation mechanism works? So that is exactly what is being clarified here in this particular GST Council meeting recommendation. Point number one, what they are trying to say is that already we have a valuation mechanism for any of the related party transaction under Rule 28. And now under Rule 28, Sub-Rule 2 is proposed to be inserted. As we insert Sub-Rule 2, which is exclusively for this particular purpose, what does it say? It's the it's the actual consideration which is involved in that transaction, or 1% of the guarantee amount, whichever is higher, that would be the value at which tax is payable on these kind of corporate guarantee. This is what exactly they have given us. Point number 1. Point number 2. Usually, typically in Rule 28, we always find this last proviso. What does it say? Whenever the recipient is eligible for full input tax credit, then the value is, what is the value which is probably declared in the invoice. So which means there is no need of a separate valuation mechanism. Whatever is the value that is declared in the invoice, that will be deemed to be the value for the purpose of GST law when the recipient of the service, or whatever it is. So when the recipient of the goods or services is eligible for full input tax credit. Now still the terminology full input tax credit has not been defined, but let's not get deviated to that issue. But what is important here is that that kind of a proviso will not be applicable for this corporate guarantee, which means what? When it comes to the corporate guarantee, no relaxations based on full eligibility of ITC for the recipient, which means the valuation mechanism which is prescribed here, that is 1% of the guarantee amount or the actual consideration, whichever is higher, that will only prevail, and there is no deemed valuation or the accepted valuation which is available in the invoice, right? So this is the second most important clarification what they have provided. Now let's move on to the third clarification which is provided in the recommendation. Provisionally attached property. So section 83 empowers the officer to provisionally attach the property of the taxpayer in the case of recovery procedure, wherein if the taxpayer has been, let's say a taxpayer has been served with a show cause notice, and then the order is also getting confirmed, or let's say even at the appellate level or whatever it is, and the time limit for the appeal procedure has also lapsed, which means the order demand gets crystallized, right? So at that point of time, if the taxpayer is still not paying the tax liability, then the officer has got the power to go for recovery mechanism. As part of the recovery mechanism, section 83 empowers the officer to attach the property provisionally, which means it's a provisional attachment, and subsection 2 of 83 also clearly states that this provisional attachment is valid only for 1 year, and it ceases by the end of that 1 year from the date of attachment of the property. But what practically happens is that this, after the lapse of 1 year also, the provisional attachment continues, because the officer has to manually lift the provisional attachment, which is not happening. And these kind of concerns have actually gone to the High Court, and High Courts have already given relief mechanism to the taxpayers on a case-to-case basis. But having said that, it's very clearly implied in the law that this provisional attachment operates for only 1 year, but whereas it's not happening in reality. So to put an end to this, a specific rule amendment is proposed to be introduced under Rule 159, wherein once this DRC 22, which is the form for this provisional attachment, has been issued, by the end of the 1 year, this automatically lapses, which means what? Automatic restoration of the provisionally attached property at the completion of 1 year from the time of attachment. So this is a very welcoming change which the GST Council has recommended in this particular meeting. Now moving on, we are going to category or the point number 4, which is on various clarifications that are proposed to be issued relating to place of supply, right? But having said that, they have not clearly mentioned what exactly is going to be the clarification, unlike the other scenarios. So let me only highlight what is exactly the categories for which they have stipulated that a circular or a clarification is going to come up regarding the place of supply, right? Point number 1 is on the supply of services relating to transportation of goods, including mail or courier, right? So all these kind of transportation of goods wherein either of the parties, either the supplier or the recipient, is outside India. So which means what? Cross-border transaction of services relating to transportation of goods. Regarding that, the place of supply determination is going to be clarified. Point number 1. Point number 2 is advertising services. Point number 3 is on co-location services. On these 3 categories, place of supply related clarifications are proposed to be provided, and we are not clear at this point of time on what exactly is going to be the clarification, so we are not going to discuss much into it. The next one, fifth category, that is on a very, very important aspect which I would say is a welcoming relief from an exporter of service perspective, is that export of service. If you see already under FEMA, RBI and FTP, all of these have been very clearly, it has been stipulated that in line with India's macroeconomic policy towards internationalization of INR, RBI permits receipt of export proceeds in INR through special pass-through INR account, right? So this has been already permitted. Now coming to GST law also, GST law originally, if you see the IGST section 2 subsection 6, which stipulates the definition of export of services, there is this fourth clause which says that originally how it was worded is that the forex has to be realized. The foreign remittances are to be realized for a particular supply to be qualified as export of services. And then they already amended in 2018-19 itself that INR is as well permitted wherever it is being permitted by the RBI, right? So which means it's only about realization of the export proceeds. It has to be in forex currency, but however, wherever RBI is permitting INR receipts, INR is as well accepted, right? So this has been given in the GST law as well, and RBI has also already given lot of circulars time and again very clearly mentioning that any receipts from special pass-through INR account is being accepted. See, it's very simple because India wants to internationalize INR. So naturally first we need to accept the INR, isn't it? Now on those lines, what happens under the GST law is that when it comes to refund, circular plays a very important role. Of course, circulars do have its own limited applicability, but having said that, when it comes to at least the department offices, they completely go by the procedures which are laid down in the GST circulars. And circular 125, which is the master circular which is issued for GST refunds, it clearly stipulates in Annex A what are all the list of supporting documents that needs to be given at the time of refund application for the refund to be processed by the sanctioning officer. And when it comes to the export of services, what is given is the FARC or EBRC or any other document that is for the purpose of substantiation that the export proceeds have been received. Even though the circular states that any other document, unfortunately what happens is when it comes to the offices, unless it is being very clearly defined, because any other document is something which is very wide or vague, but what is specifically given is the FARC or DRC, and hence the officers do rely only upon the FARC or DRC to ensure if the export proceeds are being received. And eventually what happens here is that unless the FARC or EBRC is being produced along with the RFT01, the refunds are getting outright rejected. But the reality is that FARC or EBRC is not at all possible for the exporter to obtain, because for a simple reason that the money itself is not received in the forex. The money is received only in INR, and it is no way possible for the banker also to issue FARC or EBRC. With all those issues, what happens is that the exporter of services are facing real-time tough situations. The refunds are not getting sanctioned simply because FARC or DRC is not available, even though the money is received through special pass-through INR account, which is completely permissible under the RBI guidelines. Having understood these difficulties which are faced by the exporter of services, now the GST Council meeting, it's a very good welcoming recommendation that they have given, that when the money is received through special pass-through INR account and it has to be accepted as export proceeds to fulfill the conditions under section 2 subsection 6 and clause 4 of IGST Act, which means that the proceeds for the export of services have been received, so that the transaction qualifies to be export of services, and thus the zero rated supply benefits are also being received by the exporter, and the refunds are to be sanctioned. So it's a very good welcoming recommendation that the GST Council has given, having taken the representations given by these associations. Now let's move on to the next sixth important recommendation which has been given relating to the supply to SEZ unit. Now what happens is, whenever the DTA supplies goods or services to SEZ unit or SEZ developer, that is being covered under IGST section 16. As I already given in one of my video on the changes relevant for exporters with effect from 1st October 2023, I have dealt with in detail on what are all the changes that has happened in section 16 of IGST Act. So to be precise, section 16 subsection 2 of IGST Act has been changed, wherein previously if you see there were two options which were available always for a zero rated supply, either with payment of IGST or without payment of IGST. Now that has been removed, wherein without payment of IGST under LUT is only made as the default option, and with payment is permissible under subsection 4 only if it is being notified by the CBIC. And again, when it comes to notification, there are two types in which it has been given under subsection 4, either as a class of person or as a class of goods or services. And again, when it comes to class of goods or services, it's only for export, whereas the class of person is what is given for zero rated supply, which covers both export as well as SEZ. Now coming to what exactly was the issue here is that notification 1/2023 IGST has been issued already under this particular section 16 subsection 4 to notify which goods or services are in fact prohibited, and not, what the notification 1/2023 says is that the class of goods and services for the purpose of export, it basically gives for all goods and services except for those which are being listed, which is like the pan masala, tobacco and some of the essential oils. But here the issue is there is no notification which has been given under clause 1, wherein the class of persons are being permitted to make export of goods or zero rated supply of goods or services with payment of duty. So in effect what happens here is that SEZ, whenever the DTA unit is supplying goods or services to SEZ or SEZ operator, because of a technical defect in this particular notification 1/2023, which is issued only for exports and not for SEZ, typically with effect from 1st October 2023, whenever a supply is being made to the SEZ or SEZ developer, it is not possible to issue an invoice with payment of integrated tax, and that tax being claimed as refund. So because of this technical defect, the supply for SEZ has only one option, which is without payment of tax under LUT, right? So in order to nullify that impact, because that is not at all the intention of the government, so to align it with the actual intention of the lawmaker, it has been already proposed that the council has recommended to amend this notification 1/2023 so as to make it suitable that whenever a supply is made to SEZ, it is being completely allowed under with payment of duty, so that the supply invoice can be issued with IGST and that can be claimed as refund through RFD 01, right? So that is again a very important recommendation. I would say it's not a great relief, rather a mistake which has been done, a technical mistake which has been done while issuing a notification under 1/2023, and that is now proposed to be corrected by way of an amendment. Now let's move on to the next category, which is other measures pertaining to law and procedure. There are two aspects which has been discussed here. Point number 1 is on the constitution of the GST Appellate Tribunal. So GST Appellate Tribunal constitution has been a long debated issue under the GST law for the last couple of years, and in spite of all that, till date we don't have the Appellate Tribunal as well. But having said that, now again an amendment is proposed in section 110 of the CGST Act, inserting couple of changes. Basically the objective is to align the Appellate Tribunal related provisions in the CGST law with the Tribunal Reforms Act 2021. There have been some disconnects between these two, and basically the objective is to realign these two. Now what happens is, way back in 2019, Revenue Bar Association has already filed a writ petition in the Madras High Court, and the Honorable Madras High Court has given, basically has squashed the then existing proposed GST Appellate Tribunal constitution. And then again the government has come up with revised provisions, and once again what has happened is Madras Tax Bar Association, even right now there is a writ petition which is pending in the Supreme Court on this matter. Last month also there was a hearing which has happened, and coming back, what exactly was the issue? the major demand from the tax professionals, it's not just a demand but rather I would say a legally valid way of constituting the appellate tribunal, is that to include advocates who are experienced advocates under indirect taxes as judicial members while forming the appellate tribunal. So this has been a long pending request from the tax professionals, and having understood that request, for which the debates as well, I would say not just the debate but rather the litigations which are going on in the Supreme Court, now the GST Council has also recommended some of the changes. Hopefully even the writ petition might get withdrawn after this. Let's wait and watch, and that would happen only after seeing how the amendments are being actually constituted in this section 110. Now there are three major changes which has been proposed. Point number 1 is that at least 10 years of experienced, in fact substantially experienced advocates in litigation practice in the indirect tax regime. It can be under the VAT tribunal or the service tax tribunal or SST, whatever it is. So the tribunal or the High Court or the Supreme Court. So the objective here is at least 10 years experienced advocates are also qualified to be part of this judicial members for constituting the GST Appellate Tribunal. Point number 1. Point number 2. When it comes to the age limitation of the president and members of this Appellate Tribunal, there are two things. One is the minimum age criteria, which has been now prescribed as 50 years. And when it comes to the maximum age cutoff, previously it was 65 years for the member, which has now been revised to 67 years, and again 67 years for the president, which has now been changed to 70 years. Again, this is alignment with the Tribunal Reforms Act 2021, right? So these are the three major changes which has been proposed, and especially now that from a taxpayer's perspective or from a tax consultant perspective, the one important thing which you have to understand is that now that again some amendments are proposed in section 110, and hence the formation of the appellate tribunal is once again going to get deferred, because these amendments are to be proposed and then that has to be passed in the parliament, and then it has to be effectively implemented in the act, and only then the constitution of the appellate tribunal can start with. So we have to wait and watch how the litigations are going to move around when it comes to the GST issues. Now let's get on to the last part of the 52nd GST Council recommendation. This is on the IST. When, if you can recollect, the 50th GST Council recommendation, one of the point what was given is on the IST versus cross charging. There have been several relaxations, I would say a larger benefit which has been given, and clarifications were also being continued based on that by way of circulars. So even though the circular gives a clarity that IST is not mandatory and that the cross charging is as well not really mandatory, so all these things have been given in the circular. Now going back to the press release of 50th GST Council recommendation, there is one more point which has been specifically given, that IST is going to be made mandatory prospectively, which means going forward it is going to be made mandatory. On those lines, now 52nd GST Council meeting has recommended to make suitable changes in section 20 to make this IST mandatory going forward. So IST, I would say, already we have a very detailed video in our YouTube channel on what is IST, what is cross charging, how does it work, and what are all the clarifications which has been given. Probably we will also share the link in the description as well. Now coming back, what is IST? To keep it very simple, if there is a third party vendor who are providing services to various branches of a company, and there is a consolidated billing system that comes to the head office. Now the head office, even though it is just that the invoices are being recorded, the inward invoices are being recorded for the sake of a centralized billing pattern, the actual services are being received in the concerned branches, and hence there has to be a distribution mechanism through which these services, the input tax credit relating to these services, are again given back to the respective branches. That is exactly how this IST mechanism works. Okay. So now with this we are concluding with all these 8 major changes in the 52nd GST Council recommendation. Hopefully this video would have given you a lot of insights. Thank you so much and stay tuned for more GST with Saradha.